Hi everyone, welcome back to this series of videos on Ind AS, that is Ind AS with Accountsman. In the previous lecture we were discussing impairment of assets. Sorry that I kept you wait for a little long for this third part. Yeah, so without wasting any time, let's get started with that part of Ind AS statistics that we didn't discuss. So previously we discussed what exactly do we mean by impairment, the grammatical meaning of the word impairment, and what do we mean by asset, which we've been reading multiple times, and what and all does it include in the purview of asset for Ind AS statistics, and what are those assets which are not covered in impairment. So we've discussed that. And taking it a little ahead, I told you what exactly is the word impairment when the carrying amount is greater than recoverable amount. Yeah, everything was done. We also discussed why does an organization go for impairment, or why do they impairment, and why is it not like downward revaluation and it's different. Yeah, and I also told you when like when the indicators are there is when we go, but at certain instances we do impairment even when there is no indicators. So I told you those things also without indicators. So we discussed that internal external indicators, and this is what the crux of the entire discussion was, like how do we basically compute the impairment loss. Yeah, we discussed this. Impairment loss is excess of carrying amount over recoverable amount. We determined how to compute carrying amount, how to determine recoverable amount, but whatever we done was just the overview, but we need to go dig deep into this particular topic and then go ahead. So carrying amount, there's not much of difficulty. Carrying amount, it's the same. We are done with carrying amount. That way, carrying amount, there's nothing new to be learned. Carrying amount, we take the purchase price or initial recognition value. From this, we deduct the accumulated depreciation and impairment loss, which is already deducted till date, and that's the carrying amount. But the discussion becomes really interesting with regard to recoverable amount. When we say recoverable amount, it should be seen whether the action taken by the organization is to sell the asset or is it to hold the asset in the operations. If it is selling the asset, then we go for fair value minus selling price and selling expenses, and if it is to be used in the operation, then we determine value in use. This is what we discussed, and higher of these two is our recoverable amount. Now let me take you a little ahead, and we're going to discuss this concept of recoverable amount a little in detail. So the discussion is about recoverable amount determination. So how are we going to identify the recoverable amount? This depends upon the asset. So with respect to asset, we need to check if asset has independent cash flows. Yeah, so very important term. What should we check? We should check if the asset has independent cash flows. Without depending upon any other asset, the asset should be able to generate some cash flows. So there can be two answers to this question. The answers can be yes, the asset has independent cash flows, or the answers can be no, the asset cannot generate independent cash flows. Now let's see in each of the case. If the asset can generate independent cash flows, meaning without being connected with any other item in the organization, exclusively that asset can generate revenue, can generate cash flows for the entity. Maybe in the organization I have a truck, and my truck is being used to render services to my customers, like transport services or transportation of goods or passengers. So exclusively the truck is generating me some revenue. So that is what you say is an independent cash flow generated from that asset. If I'm using the truck within my factory to move the goods from one process to another process, then whenever the truck is used in the transportation within the factory, that will not generate any cash flow. Only when the final product is sold, I can generate cash flow. So if a truck is used for movement of goods within the factory, it cannot generate, we cannot say that it generates independent cash flows. Whereas if a truck is used to give direct service to a customer by transportation of goods or people also, transportation or anything of that sort, then I can basically call that as my an asset which generates independent cash flows. So if it is an asset which can generate independent cash flows, then we basically identify recoverable amount for that specific asset only. Single asset for recoverable amount determination. So I'll see only that asset's revenue and I will determine my recoverable amount. However, if the answer is no, recoverable amount, R is recoverable amount, is determined for CGU. Now this is interesting. What did I tell? I told the word CGU. Now you might be wondering what exactly is CGU. Yeah, so very important term. We'd have to discuss this in detail. Let me explain. CGU refers to cash generating unit. Yeah, the next question that you might have with you is, what exactly is CGU? So the answer is pretty simple. CGU is smallest identifiable group of assets. Smallest identifiable group of assets which can generate independent cash flows. Yeah, so whenever asset in isolation, that asset in isolation cannot give us independent cash flows, then what do? Whenever we go for recoverable amount, we will not be identifying it for single asset. We identify CGU. So we tag that asset along with a group of assets. Together they form a specific CGU, that is cash generative unit, which will have independent cash flows. And what we do is we identify recoverable amount, that is what is the fair value minus selling price as well as our value in use for CGU. And the carrying amount also will be taken for CGU as a whole, and impairment loss also will be determined for CGU as a whole. You get that? So what happens in this particular case is recoverable amount and carrying amount will be determined for CGU as a whole instead for single asset. Instead of doing it for single asset, we do it for a CGU as a whole. You get this? Then what will be the consequence? Impairment loss will also be determined for CGU as a whole. CGU as a whole, we cannot identify the impairment loss for that specific asset upfront. We'll identify it for the entire group of assets. Now, once we take a specific asset into a CGU, are you allowed to change the classification in the coming years? Now, I have one asset 1. It was part of CGU 1 this year. Can I take this asset 1 into CGU 2 in the next year? That is the question. Okay. The next question is, can there be change in classification of asset into CGU? Yeah, very common question, frequently asked question. Let's answer this. Yeah, asset is classified into cash generating unit on two things. Okay, first one, reasonable, meaning it is not like the whims and fancies of the organization or the management. Management wants it to associate this particular asset to this CGU. Can they do so? No. We should check if that is the smallest identifiable group. If that asset belongs to that group, we should put it into that group. If not, we will not force that asset into that group. So that asset should work along with the rest of the assets in that group to generate cash. Only then we'll add that asset into that CGU. So it should be reasonable. Second thing, it should be consistent. Yeah, we cannot change the classification of an asset from one CGU to another CGU just like that. So it has to be reasonable, it has to be consistent, meaning if A1, asset 1 is part of CGU 1 this year, the subsequent financial reporting period, that asset 1 should be in CGU 1 only. It cannot go to CGU 2. You get this? However, there is exception. However, yeah, reclassification is allowed. What do I mean? Reclassification is allowed. You can take that particular asset from CGU 1 to CGU 2. You can change that CGU under which that asset is classified. When can you do this? When there is change in utilization. Yeah, previously that asset was tagged along with certain group of assets for generating cash for in the process of operation, but now genuinely that asset has been changed, the utilization of that asset has been changed. Now assume you had a truck which was there in the factory and the goods were used to be moved within the factory using that truck. So you categorize the truck into the CGU of the factory, but now the truck has been moved from factory to warehouse. Now using the truck within the factory, sorry, you are no more using it in that factory, you are using it in the warehouse. Then what happens? The truck which was previously classified into the CGU of factory should now be classified into CGU of warehouse. So is that classification allowed? Reclassification? Yes, because there is a change in the utilization. When the utilization of that asset is changed, then you are allowed to change the classification of that asset into the CGU. So that is, reclassification is allowed whenever there is change in utilization. Now taking it ahead, I told you the CGU concept. So in this recoverable amount, we understood how to go about with this recoverable amount little. So I'll draw a line here. Okay. Next thing, we have with respect to sale of the asset and we have with respect to use in operations. Whenever we have sale of the asset, we need to determine the fair value minus selling price or selling expense incurred for the purpose of sale. So how to determine the fair value? So we need to discuss that in detail. Then whenever we go for value use in operations, then we have value in use. So that also needs to be discussed in detail. So what I'll do is I'll write it all again, number them, and then I'll go about it. Wait, recoverable amount, continued discussion. Two things, isn't it? So what are they? First one, if it is sold, okay, sold, used in operations. Now tell me, whenever we go for sale, what do? We do fair value, right, less cost of disposal, or I can write selling expenses. Yeah, and whenever we go for used in operations, we go for value in use. Yeah, so now I'm going to discuss each of them in detail. The first thing that I'm going to discuss is my fair value. Yeah, and the second point is this one. Yeah, so let's get started. The first point of discussion, number one, fair value. How do I determine the fair value of a specific asset? Okay, firstly we need to go by Ind AS 113 fair value measurement. So it will be the basis for determining the fair value, and I'll give you the order of things in the priority in which they actually should be considered. So the first thing, we need to go by the binding sale agreement. Now if I've already signed a sale agreement and that sale agreement tells me certain price at which I'm supposed to consider, I'll go with that sale agreement. Now assume I've already entered into one contract and that contract is binding on me. In that contract I've specified a price of 10 lakh rupees. So that price will be considered as my fair value. What if there is no binding sale agreement? Then you'll go for priority order number. That would be bid price, or what to say, the recent transaction price. Now instead of me entering into contract with one person as a contract which binds me to sell it to him, if that is not there, then I could have kept an open bid, and if certain bid I've got, one person has told I'm ready to buy at this price, so that is the bid price, that would become our fair value. Or if there is any recent transaction which is done with respect to a similar asset by me, that would also become the basis of an item which is called as fair value. So that can be considered as my fair value. If that's also not available, then I can go for best estimate. On which date? On reporting date. So we're talking about an asset against which there is no agreement signed. So I have not signed an agreement saying that I'll sell this. So there is no binding sale agreement. Nextly, no one has come and offered me that they'll buy. So there is no bid price, and there is no recent transaction also made against that specific asset or a similar asset. So then there is no binding sale agreement, no bid price, no recent transaction. Then what do? I'll go by the best estimate available. What is the best estimate? We need to quote the reasons why this is the best estimate. The basis for that estimation is to be quoted. Yeah. So the best estimate available on the reporting date is to be arrived at. If you don't even have the number 3 with us, then we need to ignore fair value and consider value in use only. You get that? So if 1, 2, 3 is also not available, 1 is also not available, 2 is also not available, 3 is also not available, then what do? Ignore this and we'll only consider, consider only value in use. You get what I'm trying to? Straight away we'll take value in use. Whatever is value in use will become recoverable amount. Whatever is value in use will become recoverable amount. This is the fact with respect to fair value. Now let us move ahead and then discuss used in operations, shall we? So that's our point number 2. Now the question is, how do we determine value in use? Yeah, value in use, as you people already know, it is determined as what? Present value of future cash flows. What do? We do present value of future cash flows. Now how do we arrive at present value of future cash flows? It is a multiple of 2 items. That is future estimated cash flows multiplied by discounting factor. And whenever we are referring to present value of future cash flows, it is from asset, from that asset or CGU. If we are taking single asset, then we go by asset. If that asset is not generating independent cash flows, then we take it for the CGU as a whole. So we need to identify future estimated cash flows multiplied with the concerned discounting factor. That's how we arrive at the value in use. Then we take that value in use and then compare it with our fair value less cost of disposal. Whichever is high becomes our recoverable amount. And if that recoverable amount is, if we deduct that from the carrying amount, then that becomes our impairment loss. Okay, long way. Now let us get going. So the first and foremost thing that I want to discuss here is estimated. When I say the word future, it is not present, it is after today. So after today, in the future, if there are any cash flows, that cash flows is to be discounted. Now in the future, how much cash will flow in, how much cash will flow out, how do I know it? I would have to, how do we basically arrive at that estimation? How can I be able to predict the future? It will be based on certain things. Now I am going to discuss what exactly do we mean by estimation. Okay, the first and foremost thing is this estimation should be reasonable. This estimation should be reasonable. And the next thing is it should be based on economic conditions. See, right now the current pandemic state, what we are going through, the economic conditions have completely changed. Now I cannot be taking into consideration the economic conditions in 2019 when I make estimation. Now I need to consider the economic conditions prevailing on this date when I estimate my future cash flows. So it should be reasonable, it should be based on economic conditions, and then I should give more weightage to external conditions than what is there internally to the organization. So external evidence, higher importance, okay, should be given weightage. Now even through this pandemic, I might be feeling very positive, my organization might be feeling very positive, but the current state is such that our company belongs to an industry which is completely going down. In such a situation, you cannot say I will swim across this, I will fight harder, I will pop out as a big one. No, you need to give higher weightage to the external conditions that are prevailing. And if there are any changes that is happening from the existing budget and forecast. Now initially you made one budget and there is one actual performance, and this budget and actual performance were not meeting. The difference between that budget and actual performance is what we call as variances. That's what we do under standard costing and everything. Once that variances have been arrived, after comparing the actual with the standard, we make corrections to the budget, upcoming budget. Such changes that is being made to the budget and forecast should be considered. What I am trying to tell is, with respect to the changes in the budget or with respect to the changes in the forecast, that should be inculcated in the estimation. Isn't that the main objective why we do standard costing? See, first we do budgeting, then the actual performance happens. The budget might not be equal to the actual. We compare, that is a standard costing completely we do. Identifying the variances. Why do we do these variances? So that we can, when we are doing the budget for the upcoming period, we can consider them. Similarly, here when we are preparing estimation, we need to consider the changes in the budget and changes in the forecast. Yeah. Changes in budget and forecast should be considered. If there are any changes, those should be considered. And lastly, subsequent events. Yeah. So after these estimations have been made, and before we put them into force, if there are certain things happening which would lead to change in our estimation, those changes also should be considered to re-estimate the cash flows. Okay. So this entire discussion was with respect to estimation. So what should we do? We need to estimate the future cash flows. So that future estimation should be reasonable. It should be based on the economic conditions. External evidence will have higher weightage, and changes in the budget or forecast which were previously made should be considered, and it should also consider subsequent events. This is how we determine the estimation. Yeah. And the next question is, what exactly are we trying to estimate? Which color do you pick? I'll pick black. Yeah. Which, no, not black, I'll take blue. Yeah. Which, no, red is nice. So basically what are we estimating? We're estimating cash flows. So the next discussion is with respect to cash flows. Yeah, I don't think this place gives us enough time. I'll basically take you to the next. Okay, fine, I can do it here. Whenever I say cash flows can be two: inflow, outflow. So whenever we use the word cash flow, the future estimated cash flow, this cash flow can be in as well as out. So inflows as well as outflows till disposal. Till disposal has to be considered. Now, whenever we talk about cash flows, what cash flows are considered and what cash flows are not considered is the important discussion. The cash flows that are considered is normal operational cash flows. So in the normal course of operation, any cash flows are there, inflow and outflow, both are considered against that asset. But now the interesting question is, what cash flows are not considered? If those cash flows are with regard to restructuring or reconstruction of the entire operations, then such cash flows should not be considered as a part of our, the cash flows estimation for discounting to be used as value in use. Next, if they are for improvement, improvement of the asset. Now there is an asset, we are trying to improve that asset. This is not in the normal course of operations. That is to give higher economic benefit from the asset. So if such improvement costs have been incurred, that will not be considered as a cash flow for the purpose of value in use. Ignore such cash flows. And the next thing is finance costs, like interest or anything relating that specific asset, or in general, these cash flows are not considered to be normal or operational, and these cash flows are not discounted to be part of our value in use. And the last one is tax. So if there is any taxes paid against that specific asset, maybe something like environmental tax, or maybe your corporation tax, or anything that is paid, that again taxes are not part of your normal operations, and such tax is not discounted and not considered to be part of our value in use to determine your recoverable amount for ultimate computation of impairment loss. Yeah. So this is with respect to cash flows. So we're done with the future estimated cash flows part. Now the discussion will fall into or regarding discounting factor. Now, how do we determine the discounting factor? Yeah. So let me talk about the discounting factor. So when we talk about the discounting factor, we need to see how do we arrive at that rate. Yeah. So we should check if there is any asset specific rate available. If asset specific rate is not available, then we'd have to go by the weighted average cost of capital or any other borrowing rate available. But at the outset, what we'll be going with is the pre-tax market rate is what we'll consider. You get that? So now let me go ahead and then discuss this part in detail. Discounting factor. Yeah, discounting factor. So the first and primary thing is we go by pre-tax market rate. Pre-tax market rate is what we consider. Now we need to check if there is asset specific information. We need to check if there is any asset specific information. So the answer can be two types. The answer can be either a yes or it can be a no. Yeah, whenever the answer is a yes, I'll write it. Oh, I messed it up. Sorry. Yeah, whenever the answer is a yes, then what is it that we should do? Determine what is it, asset specific discounting rate considering time value of money will be also be an important consideration along with inflation if any. Yeah, both together will become the basis based on which we will identify asset specific, what is a discounting factor. If there is no asset specific discounting factor, or if there is no asset specific information, then what do? Then we go by weighted average cost of capital. Yeah, or we can also go by other borrowing costs. Yeah, any other borrowing rate is also fine. So this is how we determine our discounting factor. So now what I've done is I've taught you how to determine the discounting factor, how to determine the future estimated cash flow, estimation, how to do it, cash flow, how to do it. We've done that. So basically we've done with value in use. If I take you back, we're done with value in use. We've also done with this part, fair value part. So we'll be done with the recoverable amount. So if I take you a little more back here, so I've told you recoverable amount, when to go for CGU and when not to go for CGU. So we're done with recoverable amount, we're done with carrying amount. Finally, we've arrived at the impairment loss, what is to be considered. You get what I'm trying to tell? So this impairment loss can either be transferred to PL or it can either be adjusted against the revaluation reserve. Now this impairment loss, what has been identified, can either be for a single asset. Impairment loss, whatever we've identified, can be for single asset or it can be for CGU. Now how do we treat this? It is very easy cheesy when it is for single asset. What do? Deduct from that asset, or what do you say? Okay, asset and P&L. We transfer it to P&L. Oh fine, I'll write it. Deduct from the value of that asset. So either we can transfer it to PL and two options. We can either transfer to PL or okay, reduce revaluation reserve. Now the interesting discussion is how do we treat it when it belongs to CGU? Because for the purpose of impairment we clubbed the assets to form CGU, but in the balance sheet though assets are there individually, no? What do? We clubbed the assets to find impairment loss. That impairment loss is for all the assets together. Now we need to divide that impairment loss among all the assets. We need to divide the impairment loss among all the assets. How do we do it? I'll tell you. Okay, impairment loss to be assigned to all the assets in CGU. How do we do it? Firstly, you need to check, does that CGU has a goodwill in it? If that CGU has a goodwill in it, first and foremost thing, completely deduct that goodwill. Then if there is any balance left, that will be proportionately allocated among the other assets. If there is no goodwill, straight away allocated to other assets. You get what I'm trying to tell? So the answer is like this. Yeah, what do we do? Pro rata apportionment. Yeah, based on carrying amount. Yeah, pro rata apportionment based on carrying amount. Impairment loss is to be proportionately allocated based on the carrying amount among all assets in CGU. However, very important point, if there is goodwill in CGU, what do? Then first adjust impairment loss against full value of goodwill, and only balance is apportioned to other assets. You get this? So in the CGU, you should just check first, is there goodwill, is there no goodwill? If there is goodwill in the CGU, impairment loss first adjust against goodwill. If the impairment amount of impairment loss is less and the goodwill is more, that's it, entire impairment loss adjust against goodwill value. If it is a case where the goodwill value is less and impairment loss is more, assume goodwill is 80, impairment loss is 100. So 100 rupees impairment loss is adjusted against goodwill first. So 20 rupees of impairment loss is still pending after we write off complete goodwill. that remaining 20 will be adjusted against the apportion to other assets in the CGU in the ratio of the carrying amount. So for goodwill, no carrying amount considered. Now you might be wondering, sir, why is it that goodwill complete amount we are adjusting? Because goodwill is not amortized. Usually tangible assets we depreciate, no? Intangible assets we amortize. Under the Ind AS or IFRS era, there is no concept of amortization of goodwill. We only need to test goodwill for impairment at the end of every period. So if there is any decrease, that is firstly adjust against goodwill, because you don't get another opportunity to reduce goodwill. So first and foremost thing, reduce goodwill. So if there is anything left after adjusting goodwill, such balance you adjust against the other assets which are there in the CGU. You get this? So this is the basic discussion of how we are still not done with impairment. We are still not pending. The reason is that we just now discuss the impairment loss part and then goodwill. So I've been using this word goodwill quite a lot now. So I need to discuss this word goodwill a little in detail in the next session. So after I finish that little detailed discussion with regard to goodwill, or why is goodwill treated like this, why is goodwill taken into a CGU and then entire amount of impairment losses first adjust against goodwill. So I would have to discuss that. And then I also need to answer an interesting question as to where can the impairment loss be greater than the carrying amount? Is such a scenario possible? So the carrying amount of the asset is 100 and the impairment loss came down to 110. Now I cannot reduce that asset by 110 rupees when the carrying amount of the asset is 100. You get that? So is such a scenario possible? If it is possible, how do we handle that situation? Yeah, asset cannot be recorded at negative value, isn't it? How do we handle it? And what about the reversal of the impairment? See, when the impairment is possible, is there a possibility of reversal of impairment? So that is the discussion pending with regard to impairment, which we'll do in the last video or in the next session with regard to our impairment. You get that? So see you all in the next one. Till then, stay in the game. Bye bye.